Hi everyone, good morning. Welcome to today's session of Global Weekly Money News Review. My name is Ola and I'm excited to be here. In today's session, we have some very interesting news. And basically this happens every week. Um, Saturday mornings, 9 a.m. GMT plus one. And what we do is that we review financial markets and news around the world that affect your pocket and what you should be doing about it. Fun fact is that these sessions are powered by the Money with Club. And the Money Club is a community of investment professionals, no, of professionals who are looking to secure their finances through profitable investing. And so what we do is we talk about money, how it affects your pockets and what you should be doing. And if you haven't already, please subscribe to my channel. That's one. And then two, subscribe to our free newsletter. Join our free newsletter community where we talk about money. We tell you what's happening in the club, because this is powered by the Money with Club and all. And so let's move right in. So we started from the US global news, right? And so we're talking about the US and the fact that the United States is considering breaking up Google. So I mean, as an investor, as a Google investor, if you are a US stock market investor, then you are most likely in one of the big tech stocks, right? And Google will most likely be one of them because these are stocks that have been positioned to grow, like they've positioned themselves effectively to grow based on the products and the services that they offer. Now, what is antitrust law? Antitrust law is basically something that came up at a point where you must have competition. Whatever business you are in America, there must be a competitor. So there's a limit to how much you can grow before the government will split you up. Now, Google, there was an attempt like a couple of years ago to break up Microsoft, but it didn't quite work out. So the legislators are working on legislators slash judiciary, right? Are focused on all the big tech, but Google is in the spotlight right now. Basically, what they are saying is that their search function, which currently, for example, Apple is on their search. Apple uses Google as its back end. There are a couple of massive companies. So Google's reach and Google, the Google that we Google to search for stuff, not just the company, is like everywhere. So it's massive. So Google Chrome, Google search function is under threat, is at risk right now. And what are they saying? This company is too big. There is nobody that is close to this company. And what happens is that if they are able to push through on this, then the company is going to be split. They'll be forced to divest some of these companies, some of these subsidiaries under them. Now, what does that mean for you as an investor? For you as an investor, if that split is coming, you are going to be deciding what impact would it have on the stock of the company, because if, for example, you can tell that data is the next big thing, and then if Google is forced to divest their data source, which is their search engine, right, or is forced to divest YouTube, which is another major, do you get what would happen, right? And it's something that we need to keep an eye on for two reasons. One, because it will affect Google the company, and if you're an investor, then it will affect your holdings or the value of the stock. There will be, it will, market will sell, like market will sell. That's one. And the second thing is that if they're able to pull through with Google, then there's usually that contagion effect, because whatever the law has established with one person, they will apply to everyone. So once they're able to establish with Google, then they will now begin to look at the other big tech stocks, right? And how they are structured and how they are positioned and what they should be splitting up, right? So it's something that is major. It has been in the works for a while, but it seems to be gaining ground right now. We're curious to see how they would lobby slash position themselves to escape this. But really, there's something in America called the antitrust law, and basically, it was set up. I mean, if you watch Men Who Built America, you would have heard about it. So there were some guys that were too big, and they were the only ones, and they were controlling the pricing and everything, and got to a point where they set it up that no company should be a standalone monopoly. There must always be competition in every space. So there's a level you get to in terms of your growth that if you are too far away from your competitors, they will slow you down. Come back, come back. So we're looking out for that because it's actually going to be quite major. Now, going on to African news. And I dare say that if you are in the money with club, we'll be having like discussions around this as these things evolve. I will tell you, okay, should we be selling, should we be buying, what company will be benefiting from it? So maybe we should position with those companies. What companies might also be affected by this kind of rules, and what should we be doing ahead is the key thing ahead. So if you haven't already, join the Money with Club. Let me put the link up for you so that you can see it. You can't say I did not tell you. Now, going to Africa. So Ethiopia holders are disappointed by proposed bond haircuts. So I'll first of all give you the background. The background is that Ethiopia defaulted on their USD bond holding. That's called the Euro bond in December last year, right? I think it was $1 billion, right? And they defaulted on it. Now that's on one side. So what happens is that when an entity defaults on a debt instrument, there's usually a restructuring. A default is I can't pay my interest anymore. And interest in bonds called coupons, right? I can't pay my coupons anymore. Or I can't repay your capital back to you. So what happens is that it's not necessarily gone dead like it's all over. No, what happens is that you restructure the debt, meaning that if, for example, you owed me $100 and you're saying you cannot pay anymore, be like, okay, you're supposed to pay me $100 plus $10 in interest, 110. So maybe instead of you paying me 110 today, let's spread over the next 5 years, right? Let me say, okay, I would write off the 10 on top just to support you, but this 100, instead of you paying 100 today, so let's say I will give you 2 years where you don't have to pay, and then after 2 years you now start paying 20 for the next 5 years. That is a restructuring. So the good thing with debt is that as long as the entity is still in existence, it's not necessarily ever over, right? Especially with sovereign entities like a country. A country is not going anywhere. It's not going anywhere. They're going to be there. But a company can go so bad that you actually like go into liquidation. But for a country, even if they default on debt, they would still be there. Do you get? Hi, business online. Nice to see you. Um, I think one of these days I'll bring you in because you're always online. I see, and can have discussions and all. And so maybe please drop your chat me up in any social media handle. Chat me up in any social media handle, or yeah, and drop your contact or something so we can reach out to you. So yeah, what was I saying? So for Ethiopia, they so you have to restructure. I was talking about the restructuring process. Now, so what is a haircut? That's so I've explained Ethiopia, what happened with them, what generally happens with debts, and now I'm going on to what is a haircut. Now, a haircut is a trading term. So I started my career as a trader. So these are things that I just hear. I'm like, oh goodness. So the actual obligation was, so let me use a scenario. Let's say you actually owe $100, and then when it's time to pay, you're like, see guys, I know that you have let go of the $10, like using the scenario I gave, but can we change the principal to $80 now or $90? So in this case, they are saying a 20% haircut. So they're saying, can we now change the principal amount that I'll pay? I gave a scenario of after 2 years, you won't pay anything for 2 years. After 2 years, you now start paying every $20 every for the next 5 years. So they are now coming to say that, okay, can we make it that I'm going to pay you back only $80 out of the 100, right? Um, and then they'll now agree on the term. So maybe it will now still be the same 5 years. So meaning that they won't be paying $20 every year. They will be paying, what's the math? 80 divided by 5, right? That is what a debt restructuring is. Now that's dropping the capital from the principal amount from 100 to 80 is a haircut. So you just shave your head off. If your head was here, you now cut off this portion. Yeah, it's a haircut, right? That's what it's called. It's a financial term, actually. Now, why would they do this? Because they're saying that they're under distress, that they are under pressure. They need, and then that they're trying to match up based on the, so not as detailed, but they're explaining that they are trying to match up with the terms that on which they got some support from the IMF, right? Of course, no bondholder will be excited about it. However, I dare say that what usually happens, and you can check the trends, before Ethiopia defaulted, it was obvious. What I mean by it was obvious, you would see a trend in the pressure on the financial system, financial or the economy of Ethiopia. You see a trend in their reserves. You see a trend. It doesn't just happen overnight. Defaults, especially for sovereign entities that their economy is public, everybody can see it, is never a shock. However, what usually happens, you can check the pricing, especially if you check Ghana. Before Ghana defaulted, Ghana bonds were trading at $30, $40, something that some people bought at $100. So imagine in the markets had already punished Ghana bond for the economic situation, right? What that means is that as much as these bondholders are complaining, there is a chance that they are just doing shakara. I'm just giving you the other side of it. Why? Because there's a very high chance that they bought those bonds lower than 80. Why? Because when an economy is going into distress, especially for financial investors, sophisticated investors who are the expected people to be in the Eurobond space, you can see the trend. So if you are still in Ethiopia, it's because you chose to be. It's not because you did not want to exit, right? That it doesn't just you don't just happen to arrive there. Now, another thing to note is that there are also distressed bond traders, meaning that you're wondering, okay, so if this country is going bad and everybody's selling, why would anybody come in? Because there are some people that trade distressed bonds. Now, if, for example, I mean, let's use Ghana, that I can tell you for a fact, Ghana got to like $30. Somebody sold, but somebody bought. Now, that person that bought at 30 is saying, I have liquidity, I'm willing to wait for the negotiation. Worst case scenario, even if I get 60, I've doubled my money. That's actually what happens. So at every point in time, there are different people, um, what's it called, checking out or making sure, or like there are different people positioned depending on the risk. So it's not always dead and done for. So even as they are negotiating right now, they're just starting, but they are saying that they want to close negotiation in 3 months, before the next quarter review with the IMF. But it usually takes longer than that historically. We wish them well, but this is just for you to understand when you see these things in the news, especially when you are investing in euro bonds of a sovereign entity. It's never just always when it defaults, your money is gone. They will renegotiate, and then you'll find a landing space, and then everybody will keep up with those terms. Now, the next news out of Africa is the Nairobi Stock Exchange CEO is eyeing foreign currency derivatives in their new strategy. Now, what are they trying to do? First of all, they are saying that the major issue with offshore investors is that they can buy and sell um, in Kenyan shillings, winning from the stock market. But what happens is that when they are exiting, currency might have moved against them. So what are they saying? That they're saying that to make them more comfortable, they want to create structures that would give them more confidence. Now, what's a derivative? A derivative is something like um, I buy a stock at 1 Kenyan shilling, and then I buy a right to sell it at 1.1 Kenyan shilling, regardless of where the market is. So what does that mean? If the stock price goes down to, I don't know, what is it, pence, the below one Kenyan shilling, right? I would still be able to sell it at 1.1. But if the market goes to 1.4, I will sell it at 1.4. I hope this my derivatives class is going well. But yeah, these are things that we do. That it's quite technical, but the logic is I buy a right to sell at a fixed price. What does that do for the investor? It gives them confidence that even if the price goes down, right, my worst case scenario is that 1.1. But if it goes to 2, I sell in the market at 2. Those are the kind of things that they're trying to introduce. Now, why would they do that? Because there's somebody somewhere who is a risk trader, who is a derivatives trader, who is looking at and running some numbers. So for that person, the person might have already gone short. I was going to say something technical, but I've already sold um the stock at a higher price. So even if they have to buy from you at a lower price, they are fine. Those are it's technical, right? But they are trying to create solutions for their markets, and I think it's something that we should look out for. Because one of the reasons why the developed markets are the way they are is because of this kind of structures. They actually help keep the market up, because as one person is doing something and you think it's logical for everybody to be running away, somebody is jumping in. If nobody is jumping in when everybody is running away, then that's when the price will go to zero. But there's always that distressed trader, there's always that derivatives trader, there's always someone that's taking a counter position, and that's how the markets are more stable. So I look forward to seeing how they pull this off. It will be quite interesting to see. And then finally, out of Nigeria, Nigeria has announced finally the diaspora bond. They launched it this week. It's going to be open from tomorrow. There's all no from Monday, and 500 million pension funds open to residents in Nigeria and outside the country. Take note that it's going to be benchmarked against the 5 year. The pricing is going to be announced on Monday, I believe, and it's going to be benchmarked against the Nigerian Euro bond. So, see, you are saying you have dollars, you don't know where to invest. There are things to invest. You just need to know. AKA join the Money with Club. So we'll break it down for you. These 15 minutes cannot be enough. Yeah, it can't. But yeah, this is coming up and it's starting tomorrow. So if you are in the diaspora, and you are a Nigerian, if you are, and I mean, we would in the club we would explain the nuances. Why is it different from a euro bond? What you should be looking out for? What are the risks? What are the benefits? Blah blah blah, and we'll unpack that as we go along. So for you, there's something that's coming up starting from tomorrow. The idea is to raise capital locally, within ourselves, right? Like not looking for foreign investors. That's why it's not in the Eurobond market. It's not that. It's a domestic dollar denominated bond, and it's the first of its kind in Nigeria. And I like the fact that the Ministry of Finance is being creative at this time. And then the final thing is that the central bank reintroduces publication of key economic reports. Now, that one, I'm sure you'd have seen them like, what's the point? But I just highlighted it because I realized that a lot of people don't really know how to. So maybe you won't look at the report. I'm not even expecting you to. But just understand that there are things that people see that make them understand the direction of the market or of the economy before it crystallizes, right? So things like business expectation survey, inflation expectation report, purchasing managers index. Um, even in America, I'm sure you see things like housing market reports coming up, or they just flew past my head. There's some of these reports that come up, and then market responds to it. Why? Because it's telling you what's coming in front, right? And so it's actually laudable that this is happening. And I dare say that because I'm talking about you right now, when you see that, oh, the central bank released the purchasing managers index in the news, when you hear them talk about it, just listen. What did they say? What is the index? Is it going up? Is it coming down? Right? What does it mean? I mean, maybe we could unpack it when those things begin to happen, like individually. But the idea is that this kind of information gives you guidance. It tells you which part of the economy is working, which part of the economy has a is on the right trajectory, right? So if you are going into a business, you need to use data. You can't be sentimental. You can't say I have an idea, therefore it will work. No, you need data. So the more data that is coming out within the economy, the better for everyone. Even foreign investors will look into it. So this is just me highlighting it here so that you know that it matters. And we've overshot our 15 minutes mark by 3 minutes, and we put